All right, so where are we? Today, I wanted to just give my own analysis on how the markets moved and how you could have caught this move today and made a lot of money. So, usually, I only trade from 9:30 to 12, and then sometimes I'll hit a trade before that. But New York opens at 8:30 for us. So we let it play out for an hour and see. The reason why we would trade New York is because it has the most volume, so you can catch the biggest moves usually. So let's look at what happens. So in the days prior, we failed to break these highs. We just started consolidating, and usually when you consolidate, that means there's going to be a big move to the upside or downside. And in this case, we are going to be following the simple power of 3 or AMD. So AMD, what does it stand for? It stands for accumulation, manipulation, and distribution. So we're going to name it out. So accumulation is just when we go sideways. So as you can see, pretty easy to mark out. So we're going to get this, we're going to get a text box. We're going to mark this one as accumulation. And we're going to mark this out as, there's two AMDs happening here. Manipulation, and then, sorry, and then this red box will be the manipulation, very small, and then we will distribute down here. Where's my rectangle? Sorry. And now we distribute down here. Catch these big moves. Color this one green. Like that. Sorry, I'm gonna take away these this indicator. It's a little messy. I'm gonna take away these lines. It probably look confusing. So, very simple: accumulation, manipulation, and distribution. So I told you what accumulation is. It's when the market moves sideways and it's gathering energy. A lot of orders here. And the bigger the accumulation, the bigger the bigger the distribution usually. So, what is manipulation? Manipulation is simply a false breakout to sweep liquidity. So, what this means is when people see these highs, right, they're taking shorts because every time it touches this box, people are taking shorts so they can hit the trade, right? So, what a manipulation leg is. So there's a lot of liquidity sitting above here. So we need to break it, right? And so this is a very small manipulation, but you would see that we also tapped into this green box that I had, which is this box over here, and that is because there is liquidity sitting over here. And so we tap into it, and then we're gonna pull back, or it's either gonna be a pullback and break through, or it's a complete reversal. We'll have to see for the next day. But right here, once we have broken out of the accumulation, we can switch down to a lower time frame. So the 1 minute, the 5 minute is super strong. The 1 minute, there's a lot of noise, but if you're at a super key level, that's where you'd want to entry. Okay, so now there is, and I'm going to teach you guys about fair value gaps and inverse fair value gaps. Basically, there's 3 candles, it's 3 candle pattern, and the gap between the wicks of candle 1 and candle 3. That will be your inverse fair value gap. Alright, so there's that. So in this case, you'd want to set a buy limit at the middle, a sell limit at the middle of this, at the CE, which stands for something encroachment, which is just a 50% mark of an FVG or an IVG. But we break down even lower, right? And then let's see, there's another IFVG right here. Oh, wait, sorry guys, I need to expand this. Alright, so this would be, there's like multiple, right? There's just the gaps in between these wicks, and we're just going down, down, and down. And then here is a bearish FVG. It's the gap between this wick and that wick. So you're trying to be chasing this entry, and then eventually at the halfway point right here, you'd get in the trade. That's like the most optimal trade. I did not take that because I wasn't really paying attention, but yeah, it's right here. And so now we're expecting it to distribute to a form of liquidity. That's the way the markets move. The markets only move towards liquidity. Well, yeah, that's where they want to move, because you want to fill the orders that were made. So what is that? So I'm just marking out where a lot of orders lie. So the low of this accumulation, I mark it out right here and see how price reacts to it, right? And so there's another one right here, the low of accumulation, because it wants to sweep it to fill those orders. So I'm going to bring it over here, right? And there's this low right here. Alright, so this is the real accumulation. This line is whatever, but I just added it. And so the next point would be around, this area right here, from this box to this line. This is where we want to see it react. So what happened once we reached this form of liquidity? We tapped into it, rejected. We tapped to it again and rejected. So at this point, I'm feeling that we would probably reverse, or it's just a pullback. But we're just going to keep it very simple. So this is one trade you would hit today. You entry over here, and then usually you want to have your stop loss at the manipulation, but we're moving so strongly that I have my bias that we're not going to do that. So we're going to have our take profit at what line? Probably this line over here. You also go to the 1 minute to see how the markets are moving. So right here, look, we rejected breaking out of this box so many times. And when you accumulate so much, so I'm just going to put take profit around these wicks or over here. We'll tap into it. So this is the best trade you would take if you're paying attention. And if you entered right here, obviously you could still put your manipulation right here. It's 3-1, but I just have my bias that we're going to go down. So I'm going to entry, and then I would just put my stop loss around like that. And dude, it's a 1-9. So let's see how much you do. So let's say you want to risk, you'd risk $1,000 to make $9,000. Pretty simple. And I mean, honestly, if you entered over here, you would be making, this good entry over here. You'd risk $1,000 to make 11,000. You size up, you'd risk $3,000 to make $33,000. So yeah, so that's the first trade of the day. There's one more trade that is applicable. So price, or if you go back on the 5-minute, because there's less noise and it's easier to read the chart, as you can see, there is a supply zone right here at this box. We tap into it and then we make equal lows or barely a higher low. So you could sell here, right? But it's not super, I don't really know. I don't really trade that. But here is another one right here. So now we have another accumulation. Market's moving sideways. Market, wait, there's actually another one right here. We tap into the supply zone, manipulates back down, and then you can catch this distribution. That's if you had a little bias. So where would we put the line? We would put it, we could either take profit right here, or if you felt it, okay, here, there is a fair value gap right here, a bearish fair value gap, right? And I'm sorry I'm not really explaining these terms. You should go learn them. Pretty easy. I'm a market blue. And so this is the next draw on liquidity. Markets move towards liquidity. And fair value gap is volume imbalance. The sellers are so strong, the buyers didn't have time to fill these orders, so eventually they're going to get filled. And so we rejected this line. So obviously after we reject breaking through this line, the next step or course of action was either after we tapped back into the supply zone, we refused to break through. You'd either take profit right here to be safe, or you'd want to tap into the 5-minute bullish fair value gap, which we do. And we have CE right here, the 50% mark, take profit right here. So what would that look like? So let's color these boxes better. And obviously you have to know where the market is moving, because you don't want to trade every single AMD, or because you'll think every distribution is a manipulation. So you just have to have your own bias, right? My bias was we refused to break through, and now we're going to go up here. So the true move is going to be up here. This is just to sweep liquidity, which we did. We sweeped liquidity right here, but we didn't break through here. So this is pretty like a B+ setup to me. Let's take away this box. We don't need it anymore. So this is easier to read. All right, this is the distribution. Let's see. So where would we entry on this thing? So we could have a number of entries, but let's see. So not all the time it'll reach the 50% mark, but like for this one, I'm going to turn on my indicator. There's a fair value gap right here. Let's color it blue. So this one, it tapped back into it, and then it distributes. So you see how this is like accumulating, but there's no manipulation move, right? That's because the true distribution was upwards. There's no manipulation. Or you could kind of consider this manipulation if you want. No, not really. So your trade will look something like this. Boom, at the very top of here, and I want to have a super safe stop loss. It shouldn't go back down. If it does, oh well, you lost. And what is this? How much are you risking? I don't even know what that box is for. Oh, there we go. So it's a 1 to 4 trade. So let's see. You'd risk $1,000 to make 5,000. So theoretically, if you had perfect execution, you could have made, what was the other one? 11,000. You could have made $15,000 by only risking $2,000. And obviously, it's not going to be as clean as this. But yeah, I usually only trade between these yellow lines, which is 9:30 to 12. Some people trade from 9:30 to 11. But I like to expand my window, see if there's more moves. And potentially, actually, you could have caught a third move today, which is the real move, because we're expecting a pullback because there are so many orders that didn't get filled, right? So there's these ones that we're going to expect to either bounce towards this fair value gap right here and come back up, or we're going to break through, make equal lows, or we can fill all of these orders that haven't been touched because there's just so much stuff around here. So this is the next strong liquidity. And here. So we tapped into the CE of this bearish fair value gap. And so now you would catch this move right here. Your stop loss, I think it would just be above like I don't know. It would just be above this fair value gap, because if it breaks through this fair value gap, then we're not bearish and you got the read wrong, right? And here is your target. Your targets are this liquidity over here, or these over here, the top of this accumulation, this one right here, or these lows right here, right? So this is a line. So this is just points of interest, right? You want to just take a look, mark everything out, see how it reacts. We broke through right here, so we continue the hold. And then right now, the market's closed. So we're going to see what happens when it opens up. But when it opens up on Monday or Sunday, because the markets are closed on the weekends, there could be two things. We're going to go down a little bit and then distribute back up because we had a major dump. You look on the higher time frame, we've been going down and down because of stuff that's been happening around the world. So this could just be we tap into this fair value gap and shoot up and then ignore this for a long time, but we're going to have to see what it wants. I think we're probably going to go down a little bit, but I mean after the market closes, you just close when the market closes. So your trade would look like this. This is what the third trade of the day would look like. And it's important to look at higher time frames so you can get a good idea what price wants to move. There was a bearish fair value gap over here, and it got tapped. It got tapped into. This could have been your real entry, but I don't really look at it. I only look at the 5-minute right now. And let's see how much you make. It's a 1 to 4 trade. You risk 1,000 to make 4,000. So how much is that? The other one was 5,000. This one was 4,600, and the first one was like 11,000. That's how you could have made $20,000 by risking $3,000, $4,000 today. And yeah, very, very good day in terms of how easy the market was to read. But yeah, nothing too crazy. You see all these accumulation distributions, yada yada yada. yeah, pretty simple. If you have any questions, just ask me. I am creating a little PDF on the basics. There's a lot of, it's pretty wordy. I'm still working on it, but if you guys want it, just text me and I will email it to you. But it's just ICT basics, so it's nothing you couldn't learn on YouTube. In fact, I got the information from YouTube and then put it into the PDF. So yeah, that's it for today. I'll come back on Monday. But yeah, that is it. That is basically it. Yeah. See ya.